The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. If you ever need to get hold of me, 631-647-4694. I'm here to answer all of your insurance needs and questions and do some financial planning. And I work with hundreds of advisors across the United States in the areas of life insurance, annuities, disability, and long-term care. And we work with clients directly, and also we work with other agents and attorneys and accountants that need our insurance advice, because we are completely nonpartisan, represent every insurance company, and can give you a bird's eye objective view of your situation to help you best. And the other thing we recommend, as I've said on many programs, is putting a team together of financial professionals to help you, whether you're an individual or a business. You know, you should have a good, strong accountant, a good, strong attorney, a good, strong investment person, and you need that insurance person. And I hope to be the glue to stick all that together. Well, it has been quite tumultuous the last couple weeks. The stock market is bouncing like a yo-yo. The Fed raised interest rates earlier this week, and a lot of things are happening in the markets that you need to know about that relate to some of the products I represent and some of the things that I talk about. One of the things that happens when the market is like this, you get a flee to safety. And I talked about this on yesterday's program with Robert Bird, that there's this flee to safety. So people want to know, what do I do with my safe money, because I'm a little nervous about the market, and that's certainly understandable. So a lot of the money from the market goes into either money market funds or into bank accounts or into fixed annuities, which is one of the products that I am an expert in. And people don't understand why this instrument could be better or more beneficial for you with some of your fixed assets. And to give you an explanation of what's going on, yes, interest rates are rising like crazy, inflation's like crazy, and annuity rates have gone skyrocket to where they're paying, some is paying as high as 5% for 5 years locked in, guaranteed. So we have people flocking to these products. But they think it's going to continually go up because the Fed's going up. But here's what happened. The Fed raises their rates, and you think naturally, oh, rates are going to be higher for me, for my earnings. No, rates are going to be higher for you to borrow, not necessarily for you to earn. That's a big difference. And why does that happen? Because what happens is when the Fed raises the rates and the market gets nervous, people start flocking, let's say, to bonds. Now, here's the thing about Treasury bonds, or U.S. Treasury bonds, which is known as one of the safest investments in the world. Because people are flocking to bonds, and governments are flocking, and institutions are flocking to bonds, it drives the price of these bonds up. But when the price of the bonds go up, the yield goes down. So even though interest rates are up, the yield, the return on that bond goes down because you're buying at a higher price. So even though interest rates are up, the bond yields are going down. Now, what an annuity company does is they back up your money 108% for every dollar you put in. And how do they back up the reserves? They buy Treasury bonds. So if they're buying Treasury bonds and everybody else is buying Treasury bonds, naturally the pressure for the interest rates that they're offering right now is going to go down, and it already has in some situations. But you have a unique opportunity today to take advantage of these high rates before they go down for your earnings and for your safe money. A very unique advantage. Now, yesterday, and I've talked about this before, well, what if I put it in a money market fund? Let's talk about a money market fund real quickly. A money market fund is usually operated with a lot of brokerage accounts, and they put their money into. Now, a lot of short-term money market rates have gone up, maybe 4%, but that rate changes. It changes with the market. It goes up, it goes down. It's not locked in, number one. And number two, money market funds used to be kind of a freebie for brokerage accounts. But since interest rates have come up, like any fund, there's an internal charge of up to 0.5%, up to a full percent possibly, of charges that you don't see inside that fund. So even if it's at 4%, if they're taking 0.5% away, you're really earning 3.5%. And that money in a money market fund is taxable to you every year. Same as a CD, same as a bank account. Now, they're offering high rates at banks, but they're very short-term rates, and they can change. So you may get a 4% rate today, or a 4% CD, maybe even a 4.5% CD, but A, it's taxed every year. B, there's no liquidity at all. You can't pull your money out without a penalty. There's no liquidity, and you're getting taxed. So it's not real growth. So it actually depreciates and does not keep up with inflation and everything else. So we offer something called a fixed annuity. Now, we have index annuities, we have other annuities, but a fixed annuity by its very nature is paying a fixed rate, let's say for 5 years at 5%. Wow, that's a huge number to guarantee lock in, and no taxes unless you take money out. 0 taxes. So that compounds every year without you touching it. There's no other instrument that you can do that with today but a fixed annuity. Now you say, how safe is it? Well, let's talk about the banks for a second. The banks have had a lot of volatility the last couple of weeks, okay? And why? Well, the banks only need to keep 8 cents on every dollar that you put in. What are they doing with the other 92 cents? Well, they're lending it out for credit cards at 25% over here. They're lending it out for mortgages at 8% over here. They're doing all these things. They're not telling you where it is. They are telling you they are investing it, but you don't know where it is. What happens if there's a run on the bank, like there has been? Well, how safe is that money? Well, you have FDIC insurance backed up $250,000. Well, guess what? The annuity companies in the state of New York have a backup fund of $500,000, which is much bigger than the bank fund. Now, remind you, the annuity company has 108 cents on every dollar that you put in. The bank only keeps 8 cents on $1. And the annuities are liquid. You can take out 10% every year without penalty, unlike a CD. It's a huge, huge difference. As a matter of fact, this week, I've gotten several calls, one from a guy who just inherited $10 million, and he says, I'm scared of the market. I don't need the money necessarily, okay? And I don't want to put in banks. What else you got? Well, we have annuities, and we have life insurance, by the way. We could put that money into life insurance and protect it multiple ways, not only from any taxation during growth, but a tax-free death benefit. So there's multiple ways of investing your money in it. Not everything, but on some of it, we want to do it. Now, growing up, I was a top math student in high school. But I drove my math teachers crazy because I'm one of these guys that I have, like the magician, like my cousin Vinny. I had to, if you gave me a formula, I had to figure it out. I go, how are these annuity companies able to offer this? Where's the money? There's got to be money somewhere. Where's the profit? And I figured it out. After your annuity is over and it sits there in these accounts, because people don't look at what they have, there are millions and billions of dollars sitting in annuities at 1% because they bought it many years ago. They set it and forget it, and they put it in their drawer, and they never looked at it again. So we are seeing so many people now all of a sudden opening up their statement, not caring. They know the money's there, but they could be maximizing that money. Instead of sitting in a 1% account, they should be maximizing it and making it look good. I'm your host, Neil Himmelstein. I can be reached anytime, 631-647-4694. I'm here every Friday at 3 o'clock, or my website, themainstreetcode.com. I have YouTube videos, and I'm on Spotify and Apple if you happen to miss this episode. Thank you, and we're going to be right back after a commercial. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I can be heard every Friday at 3 o'clock at 631-647-4694. If you're just getting in front of us, I'll tell you what we talked about before the break. Several things are happening. Treasury yields are going down. Fed interest rates are going up. Banks are turbulent. You need to look at alternatives for your fixed dollars. So we talked about fixed annuities as an alternative and fixed life insurance. Now, I work with a lot of companies besides individuals, and they're looking for tax deductions. Everybody wants a tax deduction. So there are 401ks and this and that. And just yesterday, I got a company that reached out to me. They have 30 executives at that company, and they have a 401k, but they want to give them something extra besides the 401k. Why do this company want to do that? Because they don't want to pay them more money. They just want to give them a bonus to keep them tight and interested in working with them. So one of the ways they can do it without paying them a salary and having to pay Social Security and everything else is to actually buy life insurance policies on every one of them. And they want it to be cash growth so that everybody has an extra retirement vehicle, and it's an extra way of keeping them as an incentive. And so what a great way to give them a tax-free retirement vehicle in addition to a 401k that they don't have to pay for, as well as if something happens to them, taking care of their families. Would that make you want to work with that company? I'd want to work with that company. Anybody that gives me something for nothing, I mean, that's like huge. Now, the employees are going to have to pay a little bit of taxes on the money that they're putting in for all these employees. But what a great way. But they deduct that. They deduct the money. The company gets to deduct that money. It's called a bonus 162 plan. To be technical, actually, if you want to get real technical, we added a couple twists to it, which, you know, if you have a company, reach out to me. I've got lots of creative ideas for you. We're using something called a REBA. A lot of you insurance guys don't even know what a REBA is. It's a restricted employee bonus contract. But these are some of the things that I do, and I don't want to make it complicated for the everyday person, but you need to reach out to me because I can solve the most complicated of issues in the simplest ways, and that's why they reach out to me. Another area of concern, which I just got back from Denver into the Intercompany Long-Term Care Conference. I was the only representative from the state of New York there. Mostly it was companies and what they're doing with long-term care. Because I have agents that work with me all over the country, I need to know what's out there. There's a lot of product out there that we don't have in New York, including group long-term care insurance is the biggest thing going. And there's a big reason why you want to look at long-term care insurance. States across the country are starting to look at this new tax called, we got to protect Medicaid. Medicaid is the number one provider of long-term care in the United States by far. which comes from taxpayer dollars, which comes from the state budgets and the federal budgets. New York is the number one state in the country provider of Medicaid, and yet we have the least insurance products to protect us. So what some states are now doing is they're instituting a tax for those individuals that haven't protected themselves for long-term care insurance. They're instituting an extra tax over and above to everyone that doesn't have protection themselves. New York State had a proposal in last year. It didn't go anywhere, but other states, Washington State started, California is now starting, Pennsylvania is now looking at a program to tax people for a very limited benefit that they're going to give you. Once you impoverish yourself, they may give you $36,000 towards your long-term care, which, by the way, in the state of New York and in Long Island, at $400 or $500 a day, is it going to last you, 2-3 months? Is certainly not going to take care of your needs. Now, how do you pay for this long-term care? People say, wow, it's expensive. Well, there's several ways of paying for it. The thing is, you don't want to pay for it when you need it, because then forget about having insurance or not having insurance. It's ridiculous. It will impoverish you one way or another unless you're mega rich. So people think, oh, I'm going to self-insure. Well, what are you going to take out your 401k and your IRAs and spend it all down and pay taxes on it, and then just for your care, just to have somebody in your home, or to keep you away from the bad place, the nursing home, which nobody wants to go to, but some of us end up there, and with Alzheimer's and mental issues lasting 10 and 14 years. What a drain that is financially and emotionally. You need some sort of insurance to protect you. People think, oh, it's expensive. Well, you can buy it at typically retail, standalone product, and the prices have gone up. Yes, but it is affordable. Or you could buy it in a combination of a life plan, or you can buy it through your business. If you buy a standalone plan through your business, it's tax deductible. I know businesses love tax deductions. It's the only tax deductible thing you can buy where you have a tax-free benefit. Tax deductible, tax-free benefit, protect your family, protect yourself and your family. There's no better way, if you're a business person, to protect yourself, not only with life insurance, but with long-term care and disability insurance is so important. Because if you're the money man or woman that's driving that family, and yet you need care, where's the money going to come from if you're not protected? So, my message is, you need to protect yourself. And if you want to get into more details, call me, 631-647-4694. Annuities, long-term care, all these things are important so that you can live a long, happy life and not be dependent on others. And that's my message to the world. I only handle protection products. I'm not after your investment dollars. Investments are investments. Protection is protection. But we can protect your assets and grow your assets without taking any risk. That's the key. The key word is risk. Yes, you should have a balanced portfolio. Yes, you should have money in fixed assets. You should have money in investments. And if you're at or near retirement age, or you are retired, you want to maximize what you have without taking risk, because who can afford to take the loss? And who can afford to take the hit? So not only do we balance out your assets, but as I tell people, as they're developing their portfolios, not only do you want to balance your portfolio out, you want to balance out your tax classes. A lot of people don't talk about this, but if you're just pouring all your money into one asset, like a 401k or an IRA or retirement asset, and not saving elsewhere, everything you do at retirement will be taxable. And I always ask people, do you think you're going to be at a lower tax bracket or a higher tax bracket when you retire? Well, the word the government has been telling you is, oh, I'm going to be in a lower tax bracket when I retire. Not the case. Not when everything you got coming in is taxable. So you need to prepare for that and have tax-deferred and tax-free investments at retirement and assets that won't hurt your retirement. And you don't want to be afraid to spend every dollar. I hate it. I have seniors that call me up. It's like, well, I don't want to pay for this. I don't want to take money out of my retirement. Well, why? Because I know I'm going to get a tax bill for it. So wouldn't it be nice to have a tax-free envelope and a taxable envelope? And we have strategies that can help you accomplish that. Whether you're young, you're old, or in between, we are here to help you plan and protect your assets for your lifetime, and we will help you grow them in a risk-free or a less risk environment than taking all your money and throwing it in the market. And I have this question all the time. You're listening to the Main Street Code for Financial Success. Again, I'm your host, Neil Himmelstein. Sorry, I'm about to sneeze. I don't want to sneeze on you. And we're here every Friday at 3 o'clock, themainstreetcode.com or 631-647-4694. Have a terrific weekend. Let's think smart, everybody, and I welcome your calls and comments. Have a great day.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsor.